Good morning, members of the public, and welcome back to Avon Pension Fund Investment Panel. It's Councillor Sean Stevenson-McGall, and I'm Chair. We've just been discussing item 8 on the agenda, our social impact portfolio, and we've had a presentation from officers and from our advisors on that paper where we discussed various issues around the pros and cons of developing that. So the recommendations on the paper are for the panel in 2.1 notes the report from Mercer's, and 2.2 the officers will undertake a feasibility study of local stroke social impact opportunities to inform our asset allocation decision at our forthcoming strategic review. Does anyone have any further questions or comments, or would anyone like to propose those recommendations? Councillor Crosley, I assume you want to propose them, and Pauline Gordon would second them. I will assume that everyone's in favour unless I see in the chat function that someone is against. No one has put anything in the chat function, therefore we have approved the recommendations as outlined in 2.1 and 2.2 of the paper. We now move on to item 9 on the agenda, which is the draft task force on climate-related financial disclosures report, and I believe our officer Nathan Rollinson will introduce this paper.
Yep, perfect, thanks. So we're doing this bit back to front. So this report was actually approved by committee last week. So just as an update, really, we're going through the design process now with our comms team. Before we publish the report alongside the RI annual report on the website. But I mean, I'm still very happy to take any kind of final comments and suggestions on the content of the report itself. And then just to note that the fund will be responding to the DLUC consultation on climate disclosures in due course. I think the deadline for that is the end of November. So we'll be responding to that shortly. Thank you.
Thank you, Nathan. Has anyone got any further comments after our discussion at the full pension fund committee last week? Nope. So therefore I need someone to move the recommendation 2.1 that we note the draft task force on climate related financial disclosures report. Can I see someone to propose that we note that, please? Thank you very much. I saw Jackie first and John second, and I assume that everyone is voting in favour unless I see something in the chat otherwise in the next few seconds. Nope, that has passed unanimous that we note that. Thank you very much. Item 10 on the agenda is the review of investment performance for the period ending the 30th of June 2020. And again, Nathan, I believe you're introducing this report.
Yep, sure. So, I mean, clearly what's happening now in markets kind of supersedes a lot of the content in the report. But last week, again, at committee, we heard from Steve at Mercer. He talked through the sort of growth and ESG tilts in the equity portfolios and how they're kind of detracting from returns. So I was just going to take the report as read, ask Mercer if they wanted to add anything at this juncture, and then maybe move straight to questions.
Thank you very much.
So I'm happy to make some comments. I mean, they're probably sort of largely similar to what I mentioned in the committee meeting last week. So there is a page in the meeting pack, page 100, which I have actually sort of shared. And I think if you look at the attribution of the return over the sort of 1 year period, it gives a very good overview of what's been happening in markets, use of key themes, and the impact on the sort of portfolio. So clearly, so equity markets are down, but we've had a benefit from the sort of equity protection that's been sort of kicking in. We've seen very challenging times for all forms of liquid return-seeking assets. So that's covered by the multi-asset portfolios. Q2 in particular was, I think, the third worst ever for credit. And some of those funds have probably been sort of suffering very recently as a result of pension funds selling assets to source collateral for LDI. The asset classes that have seen the best performance actually over the last year are the private market assets, in particular property, long lease property, long dated, and infrastructure. So you've definitely got the time horizon to be sort of holding on to sort of these types of assets, and there's very much a kind of buy and maintain asset. What we're sort of looking out for is the extent to which valuations of these type of assets might start to adjust downwards, as there does tend to be a bit of a lag between what happens in liquid markets and private markets. And we also know that pension funds are probably going to start looking to sort of try and sell down some of their private market exposures, but that's quite challenging to do, and will take quite a lot of time. And then the other factor on this slide, you can see that there has been sort of a negative contribution to the currency hedging that you've got in place, but not all of the assets are sort of currency hedged. So that's one thing to consider. But we do think as part of the strategy review, it would be good to review those currency hedging policy. So the currency hedging policy is intended to be very strategic, and does vary by different types of asset classes that you invest in. But we do think there would be a good case to review that now.
You're on mute.
Sorry, I thought I clicked it, so apologies. Does anyone have any questions on the Mercer report before anyone has any questions? We go on to the Brunel or the VAG summary. If anyone has any questions on those. Although obviously we did have a discussion, like you say, earlier in exempt and also at the full committee last week. Sorry, Pauline, I missed that. Sorry, Pauline.
Thank you. I was just going to ask, and you might not be able to answer this just yet, but do you have any idea what proportion of schemes or what quantum of assets have actually not been able to, go through with their LDI commitments? And I think longer term, it makes me think, should quite a lot of these fall away? Are we going to see a big demand for things like long lease property, alternative matching assets? But it's possibly too soon to say much about that.
Yeah. I mean, there's obviously a lot going on, Pauline. So what I've seen anecdotally, clients that have got like bespoke segregated arrangements in place have probably been able to react to market events more quickly over the last week, and those type of clients haven't had to reduce hedging levels, or they've been able to maintain the hedging that they had in place. So this isn't relevant to the fund, but some pooled LDI funds, the managers took unilateral decisions to reduce hedging. So the fact that you're large, you got bespoke, you got a strong partner with BlackRock, just puts you in a sort of real robust position there. In relation to your sort of comment question on long lease property, I think the issue that we're mindful of is just the number of private sector schemes that would be looking to do a buy-in or buyout, and the affordability of doing that has obviously got a lot higher, but the capacity of the insurance market to do lots of deals is finite. But generally, I think a lot of schemes are probably going to be looking to just sell some of those type of assets. So that could actually represent a good buying opportunity for the likes of Brunel, because they allocate actually one long lease property manager did comment to me that Brunel have been like the biggest buyer of long lease property assets over the last 18 months.
Yes.
Yeah, it's yeah. And I think even as a short while ago, of like 3 months ago, some funds were buying long lease property assets at a premium to net asset value. That was still cheaper than taking on board the full entry costs. But we're now hearing of opportunities to buy exactly the same type of assets at a discount to NAV. And that is because the private sector schemes are looking to come out of those assets for liquidity reasons.
Steve, can I just ask you, why did the pooled LDI funds take the decision to de-gear, deleverage, rather than, was it because it's difficult for them to get extra money? They weren't holding enough collateral, or they can't get it, they can't go to their clients quickly enough to get the collateral? I don't know how they work.
I think it's a combination of both.
So
that didn't happen to all pooled LDI funds.
No.
And there does appear to be that, you know, some managers weren't able to buy the gilts that they wanted to because of like general scrambling for liquidity and buying. I mean, on the first day of intervention from the Bank of England, the Bank of England was only able to buy $1 billion out of a target of 5 billion.
Interesting, yeah.
So, Nick, I don't know if you've seen anything else interesting.
No, and again, yesterday I think they only managed to buy 1.5 billion. So out of a possible of 10 billion, they've done 2.5 in total. It's more, I think it's more the signal to the market that they can step in that was the important
Catalyst,
thing. And yeah, given there wasn't that much liquidity going around, it didn't take much for them to move the price and kind of you know, keep it at similar levels to where we were a few days ago. Yeah.
Okay, so we're not having any, anyone else has identified any further questions they'd like to ask. Obviously, we had discussions at the full committee last week, because normally this would have been prior to that meeting. So that's probably why there were less questions, and given the debates that we had in exempt session earlier this morning. Therefore, if there are no further questions, can I ask someone to move the recommendation that we note the information in the reports and obviously identify issues notified to the main committee, but obviously that's already happened. Councillor Crossley's proposing that, and Pauline Gordon is seconding that, and I'll assume everyone's in favour that we just note those reports. So thank you very much, Steve and Nick, for those reports, and obviously the ones from Brunel as well. Thank you. So now we move on to item 11 on the agenda, which is the risk management framework review for the period ending the 30th of June. And Nathan, I believe you're going to introduce this item.
Yeah, sure. I mean, this is the annual review of the risk management framework that was penned to go to the original panel and then committee. But given the sort of complexity and the market dynamics at the moment, we thought it would be best to get off the agenda for the committee meeting and have a discussion at panel in the first instance. So thankfully, Nick is on hand to talk us through the paper, which is exempt. And then if you need to come back to talk through any of the kind of operational steps that we've taken to date, I can address those. So over to you, Nick, after we move into exempt.
Yeah, thank you very much. So therefore, we're going to an exempt session for members of the public watching. The panel, however, being satisfied that the public interest would be better served by not disclosing relevant information, proposes, in accordance with the provisions of section 100A4 of the Local Government Act 1972, that the public should be excluded from the meeting for this item of business because of the likely disclosure of exempt information as defined in paragraph 3 of part 1 of the schedule 12A of the Act as amended. Can I see someone proposing that, please? Thank you, John, and a seconder. Thank you, Pauline, and therefore I assume everyone's in favour of us going to exempt session. So members of the public, bear with us and we'll be back at some point in the future.